Today I just wanted to talk about how to determine the market value of property. Now, when I say market value, I mean the true market value of a property. I don't mean like what is this price of this property at this point in time. I mean, when I say determining the market value, I mean the true market value. So my name is Thomas O'Regan. I'm a buyer's agent and investor here in Australia. Me and my wife have built an 11 property portfolio over the last 3.5 years, and I make these videos to help people get into the property market and educate themselves, get educated in property, because ultimately you shouldn't be buying property unless you are educated in the space. I'm not saying you can't buy property without getting educated, but it's in your best interest to understand what it is you are buying and investing in. So the market value of property, you can break down markets into different sections and different areas and different groups. Say you can break the blue chip market in eastern suburbs into its own piece, and then you can, within that market, you can have different asset types and different asset classes. Like you might have the A grade assets, the B grade assets, the C grade assets, and say the A grade assets might be like things that have ocean views and they're on large pieces of land and they're well built properties. A B grade one might be, a house still on a large piece of land, but not in such a great location, but still in a blue chip area. And a C grade might just be something like an apartment maybe. And then, if you go on and on and on down D grade, like an apartment that's not that desirable at all, in a bad location, in a good area of the eastern suburbs. And when I say eastern suburbs, I mean eastern suburbs of Sydney, which would be Bondi Beach, Tamarama, etc., etc. Now, so each different class of asset, A, B, C, D, has different values, obviously, and they actually have different growth rates as well. And I'm just going to use this small blue chip market as an example today. But for me, when I'm doing research on a national basis. I'm looking at Perth, Queensland, I'm looking at Sydney, New South Wales, Victoria, Tasmania. I'm looking at them all on a national basis, and I break all those properties up into different markets like that. But for this example, just to try and get the understanding out there, I'm just going to use the blue chip market here, which is the eastern suburbs of Sydney. Now, these different grades, A, B, C, D, of property, they grow at different rates, believe it or not. So, I mean, it sounds obvious when I say it, right? Obviously, the undesirable apartment in a bad area, still in eastern suburbs, but a bad area of the eastern suburbs, is not going to grow at a rate. And when I say grow at a rate, I mean compounding growth rate at the same rate as like a desirable beachfront property. Just FYI. Now, when I'm trying to determine the rate of growth of that asset class, I will bunch together all the assets that are of the same asset class, like say A grade eastern suburbs properties. I will bunch them all together and look at what is going on with those properties over the last 30 years. And then I'll say, okay, this is what happened. This is what's happened in the market. For example, this is not what actually happened, but this is just an example. Say in 2014, I saw the market went up a lot. Then it came back down and went pretty steady till 2016. And then it steadily grew to 2020. And from 2020, it just skyrocketed way up there. So you want to look along that time horizon and say, over that period of time, this long period of time, 30 years, what is the average growth rate? Is it 7 for this particular type of asset? You can't compare like a one-bedroom apartment to a beachfront property. It doesn't work. But if you're just comparing apples to apples in that one, and you determine that, okay, this like A grade beachfront property is over a 30-year period is growing at an 11% growth rate per year. So then you can sort of determine, okay, that is what the property market should be performing at in this area, okay? And then what you want to look at in the marketplace is I guess like differences. Basically, you want to look for markets that have been affected and are not growing or have been repressed for a long time. And now I'm going to switch over to a market that I've had a lot of success in, which is the the Perth market. So an example of this is for me, I invested in probably C grade, maybe B or C grade apartments in Perth. I made a lot of money in B and C grade apartments in Perth. And the apartments, actually the entire market was operating the same in terms of how it was affected, but obviously the growth rate on, say, the apartments is different from the growth rate on houses. But my point is, from the marketplace in Perth from 2006 to 2014, it went on a massive boom. The growth rate of the apartments was growing so much, it didn't make any sense. Like it was unsustainable. I think the property prices went from, say, $180,000 in 2006 to, say, $500,000 in the space of 8 years. That's not normal. Like nowhere is that normal, especially not in Perth. Perth shouldn't be experiencing that much growth, okay? So that happened, but the reality is, if you look back over the history of the 30 years prior to 2006, you can determine what each asset class is growing by on average, and that, you know, the B or the C grade apartments, for example, that I've purchased, they may have been growing at a 5 or a 6% compounding rate, which is a normal growth rate. And what happened there is that growth rate went way off what it normally was for a period of 8 years, and it came down to where it should have been, which was it should have been normalized here, but it went way below there, and then it started it just plateaued, and it was plateauing about here, and the time was about, this is really hard to explain without a whiteboard or something, but the time was about here, okay? And I could see that if the properties from, like, say 1970 were growing at a 6% growth rate, they should have actually in 2023 or whatever year I was buying between 2022 and 2023, the property prices actually should have been here if the properties were growing at a 6% rate. Because of the market cycles and because of what markets do, it's not always linear, and the markets aren't always exactly where they should be. And it's my job as the investor to spot the difference and say, okay, this market, this property is undervalued. And that's where I make all my money. But basically, I invest in properties that are closer to the inflation rate than blue chip properties. Like, I'm investing in properties that generally over a long time span are not increasing by 10% compounding on a 30-year timeline. I'm investing in properties that are compounding at not quite as low as inflation, right? Inflation is, say, 3%, but I'm investing in properties that are more like a 5% increase or 5% capital growth per year. So my point is, when you see properties that are under market value, and you see properties that effectively haven't been affected by inflation a long time, you know that it is gonna have a growth spurt, because the reality is properties is an appreciating asset, so you can't, for an extended period of time, the price of property has to increase. It fundamentally has to increase because it's attached to inflation, because it's an asset. Anyway, guys, hopefully that helped, and hopefully I didn't confuse you too much. Anyway, I'm out. Bye.